Hello everyone. My name is Kamal Manocha. I represent PMS World. Welcome to another very interesting webinar on Friday evening. We have based our model of serving our clients primarily on knowledge and which we represent through content and data and analytics. And in that overall ideology, we have set a very disciplined process of doing weekly webinars discussing various themes, various strategies, various events that impact all of us. And in that stride, I can tell you, I can promise today's webinar is going to be very, very educative and very interesting. All of us, today in year 2022 have been cherishing India's 75th, anniversary after independence. And though in this year, the western part of world, be it UK or US, they are going in recession, but it's written all over, in media that Indian economy is more or less showing resilience to whatever is happening to the West. Now, many of us do believe in that patriotically, but this is a question of wealth management and investments, and hence we would want to reason it out, not just patriotically, but based on data and analysis. That why do we say that India's economy is relatively resilient to rest of the world? This is the, I would say, broad argument that we are going to cover today. And within that, we would want to understand that why is it that India's domestic consumption story, one of the pillars for basing the overall argument that we are discussing today. To discuss this, we have Mr. Maran with us from UNIFI Capital. He is one of the co-founding members and has been, pursuing financial markets for last more than 3 decades. Brings with him more than 3 decades of, pertinent experience. Under his thought leadership, UNIFI Capital has been coming up with various thematic portfolios which have been performing extremely well, and most of them have been around the consumption patterns of India. He has been very passionate about trying to understand the consumption map of India and has been early minds who has been able to identify how the consumption pattern can be used to kind of create a investment argument. And on that, I would say, thesis, Unify has been building its franchise over last 2 decades. And, based on his very successful career, today I am really, delighted that he's amongst us to share with us the entire thought process around why and how India's domestic consumption story, a very, very, big argument and kind of a reason for one to believe that Indian economy is resilient to the rest of the world, and how it can be kind of this knowledge, how can this be encashed over next decade to continue creating wealth. Welcome everyone and welcome Mr. Maran. So in the very first part of this webinar, we'll be doing a 45 minutes of a presentation, which Mr. Maran, has worked upon. And then followed by that, we'll do questions and answers. Over to you, Mr. Maran.
Thank you. Thank you, Kamal ji. Thank you everyone for taking time out to join us this Friday evening. Several months back when Mr. Kamal connected with me requesting to join for a webinar, I've been trying to discover new reasons to politely decline. Not only with him, but in general. You won't find anyone in UNIFI in mainstream media or social media for that matter. It's not that we are shy of media. We often think, what do we have anything new to say? Right? There are no dearth of fund managers, some brilliant minds in the industry. Not that we have some special skill set we can demonstrate to you that we have that you can't find with other managers. And we are humble enough to accept that we don't have any new insight, better insight than other managers in trying to understand macros or markets. Over these 22 years that we have been around in UNIFI Capital, and maybe 10 years prior to that, What we have learned over the years is our markets on one side is a crowded place. There are several. Today, the last count from SEBI is we have 348 PMS managers, um, and we have 46 AMCs which run 300 plus schemes. What is that we can do that they can't? There's nothing. But our strengths are slightly different. When our markets are extremely skewed, I don't know how many of you noticed that. Last Friday, our market capitalization would have crossed 283 lakh crores. Nowadays, investors love numbers, everything in dollar terms. It's about $3.5 trillion. But what we don't notice or overlook conveniently is the 30 companies in Sensex are worth more than half of India's market cap. As a country, we may have thousands of listed companies, but the 50 companies in Nifty are about two-thirds of the valuation. The top 100 companies are about 75-80%. It's a skewed market. For example, if you take US, the S&P 500 companies put together is 75% of US market cap. Whereas in India, 70 companies make up 75% of the market cap. So it's a skewed market. In a skewed market, two things will happen. One, if these 50 companies are expensive, whole market sounds expensive because they are two-thirds of the market. And if these 50 companies are cheap, whole market sounds cheap, which is not the reality. There are several businesses in India which are much larger but may not have large caps. And when you focus your attention to the top 100 names, you may be focusing on 80% of the market cap, but you are focusing on a handful of sectors. Banking, financial services, insurance, that makes up 35% of the top 100 stocks. Then you have 15% IT, 14% consumer goods, 11 oil and gas, 10 pharma, 7, 8 auto, 6, 7 metals. Over, right? List is over. But there are several other businesses which you may not find in this space. And therefore, outside the universe of people who focus their attention on the top 100. Now, who focuses their attention in this top 100? Who owns all this 283 lakh crores worth of equities? Like you have a shareholding pattern for a company. If you take shareholding pattern for the whole Indian equities market, you'll be quite amazed to see its nature. About 55% of the equities are owned by promoters. This is unique to India. Again, to give an example of US as market, they may have 40 plus trillion market cap, but promoters holding there is only 6.5%. 80% of the equities there are institutionally owned. And if you take the top 10 stock markets in the world, Indian market is the only market where you will find promoters holding more than half of the equities. And therefore, many strategies that work globally may not work here. And some strategies that work here beautifully may not work globally, which is an advantage to people like us. While promoters own 55%, who owns the rest? About 19% is owned by FIIs. 14% is owned by DIIs that include mutual funds, AIFs, LIC, private insurance companies, all put together. And the balance 13% is where you, me, PMS managers, family offices, retail investors, HNIs, they all come in. Why it's important to spend a minute before we even begin the presentation is to understand what matters to whom. What matters to FIA may not matter to you and me. And what's more important to you and me may not be the ones which institutions may be talking, because each one is investing elsewhere. This 55% promoters own, it may, for example, if you take the top 15 Nifty stocks, I mentioned to you they are 2/3 of India's market cap. There, little more than 51% is owned by promoters. If you take the next 50 stocks, stock number 51 to 100, the junior Nifty, maybe about 53% promoters own. If you take company number 101 to 250, so-called mid caps 150, 59% promoters own. The company number 251 to 500, 57% promoters own. Somewhat uniform. It may differ from company to company, but across large caps, mid caps, small caps, promoters holding is somewhat uniform. That's 55% promoters holding totally. The 19% FIAs own, almost about 1/3 of that is in 3 stocks. The top 3 stocks: Reliance, HDFC, TCS constitute almost 1/3 of FIA investments in India. Little more than 80% of their money is in 50 stocks. So why? Because FIAs are large, they need to make investments in several countries, and each country they measure their performance in relation to index, and therefore they choose to invest in the top 50 index stocks. If you are holding any of these stocks, then you need to be concerned and you need to be tracking what FIAs act. But if I am holding none of them, then I don't need to be concerned about FIA action. So if you take all the stocks held by all the FIAs operating in India, about 85% of their money just in the top 50 stocks. As I mentioned, there are several businesses in India outside these top 50 stocks. Surprisingly, that's not any different when it comes to DAIs. We may have 46 different mutual fund houses, 300 different schemes, 20.3 lakh crores that they manage in equities. But if you take all the stocks owned by all the schemes of all the mutual funds, the scene is not any different. Maybe about 83-84% of their money is in the top 100 stocks. If that is the space, the top 100 companies is where FIAs invest, DAIs invest. What kind of companies are they? About 35-40% of them are financial stocks, 15% IT, 14% consumer goods, 11 oil and gas, 10 pharma, 7-8 autos, 6-7 metals. Hardly about 5-6-7 businesses constitute 70-80% of Sensex, 70-80% of Nifty, and 70-80% of the market cap. But they are not 70-80% of Indian economy, which is why you will often find disconnect between Indian economy and equity markets. Some of us would have got that impression that markets should reflect what's happening in broad economy, and therefore at times when you find a disconnect between economy and markets, people begin to question. Things are so bad in economy, why markets are running up? Things are looking up so great in economy, why markets are not moving? As if Sensex job is to reflect what's happening in economy on daily basis. It's not. Sensex and Nifty's job is to reflect what's happening in Sensex and Nifty companies, not necessarily market. Because what constitutes our economy and what constitutes our Sensex and Nifty are very different businesses. For example, some of you who might have been investing for a longer period may remember between 1st January 2008 to 15th July 2013, over 5 years, 7 months, 15 days. Why these two dates? These two dates, Sensex was more or less at the same level. Over 5.5 years, Sensex, same level. During those 5.5 years, our economy, GDP, grew 8.5% per annum in real terms, almost 14% plus in nominal terms. And we are second fastest growing economy in the whole world. But markets never moved. And those 5.5 years, real estate would have tripled, construction activity could have quadrupled, exports picked up, huge capex, but markets never moved. Take last 2 years, March 2020 to March 2022, 2 financial years. So April 20 to March 21, GDP fell 7-8%, and April 21 to March 22, same GDP went up 7-8%. Net we are back to where we were 2 years back. So economy hasn't moved. But markets are up 50, 60, 70%. And therefore people question, are we moving ahead of reality? It's not. In these last 2 years, when GDP shrunk and then bounced back, were there any disruptions due to COVID and lockdown in banking business, financial services, IT? Some of them actually benefited from what happened last 2 years. And if 50% of Sensex and Nifty were these two businesses, then why should Sensex and Nifty be impacted? They actually benefited. So index is higher, earnings are higher. On the other hand, these 2 years, real estate activity shrunk a lot in the first few months, and then normalcy turned back. Construction activity shrunk a lot, textile activity shrunk, travel and tourism shrunk. These are all dominant businesses in our Indian economy, but you don't find many of textiles and travels and tourism stocks in Sensex and Nifty. And therefore, they didn't reflect that pain. So the first point to begin our evening today is when we discuss markets, when you have to discuss macros at a macro level. Okay, this is about Indian macro, how much global macros matter. That again, when we discuss global economy like US and Europe, it's slowly becoming a fashion statement to begin any conversation on investment opportunities with some narrative on global economy and markets. But when you ask people how much of Indian economy is correlated to global events, how much of our business actually is from global economy, what percentage of our GDP is exports? It's hardly about 17%. That number may be a lot for Sensex and Nifty companies, but if you take the whole of corporate universe, about 17% of our total revenues come actually from exports. But little more than 60% is domestic consumption. And this is not recent number. It's been like this for the last several years, few years. But when it comes to domestic consumption, we have not much clarity on who consumes what. Right? Who is that who? What is that what? Who is consuming what? That makes up what we call as 62% of GDP of India. So this presentation, we have two phases. First, I will take few minutes in describing the market constituents, econ, and then we'll get into specific on the domestic consumption. And we don't have too many dazzling slides or things which you might not have known in the past. Forgive me if I'm telling you something that you already know, but nothing wrong in repeating once more to drive a point which in the closing slides that you will find. How do we look at some of the opportunities in today's market in a slightly different perspective? So allow me to share my presentation. Is it visible?
Yes, Maran, it's visible.
Thank you. Thank you. First of all, when we buy equity, whether you buy directly yourself or you give money to us or any portfolio manager and they in turn buy the stocks, or you give money to a mutual fund and that buys stocks in its name, what you are buying? You are buying ownership interest in a business. If you own, some of you may be entrepreneurs yourself, and you may own 100% stake in your business. And if you own 100% stake, 100% of the business earnings is yours. If you go and do an IPO and I come and buy one share in your company, all I'm supposed to get is earnings, total net profit divided by total number of shares, earnings per share. You take any stock in any sector of any business, of any size, in any country, or any time period longer than 10, 20, 30 years, you will find the shareholders' return converging with what that company earns per share. All shareholders in a company put together cannot earn more than what that company earns per share. Okay, some may lose, some may gain, but net net, if you take all shareholders' return in a company, will equal to all the earnings of that company over a life of that company. But the share price is a function of two variables, earnings and PE multiple. When you multiply E with PE, you get price. So prices are lower today as compared to yesterday. Doesn't mean earnings of the companies are lower today. The PE multiple is lower. The PE multiple, part of it is function of the earnings expectation of future, but part of it could be cost of capital, sentiment, demand, supply, hundreds of things. And those things move so dynamically. I have no clue to even understand what drives that. So we ignore that. The only care we take in that P is whether it is corresponding to the earnings growth of the companies. But what's more important is the earnings growth of the companies, which is why when we look at buying a stock, you consider that as ownership interest in a business. And given sufficient period to hold that stock, your return is a function of how those business earnings perform. So this is so elementary, but many times we don't remember it. Now, there are different companies that move differently in different time periods. All else being equal, they may have somewhat similar management governance standards, but they may belong to different sectors. What eventually drives their growth or degrowth is the earnings performance. And this disconnect between Nifty and GDP has always been there. Sometimes it becomes so obvious and evident. Sometimes they're so subtle, but they always exist. One discussion today when we meet investors, prospects, as well as business partners, is large caps are so and so, mid caps are even more expensive. Should we look at small caps? As if these are all choices to make. As I mentioned in my opening slide, if buying a stock is buying ownership interest in a business, how much we make is a function of the ownership interest in that business. No company is going to give higher return, lower return because it's large cap or mid cap or small cap. Some companies may give higher return in a given 1 or 2, 3 years period because it's large cap. Some companies may give higher return or lower return because it's a small cap, mid cap. But over a life of its fund, over its life of the company, the returns will converge with that company's earnings growth, independent of the size of that company. So here what you see is 3 colored lines. The dark black line is what we call as Sensex. Red one is mid caps, and the gray one is small caps. So what you will certainly see over the last 20 years, 20 years is good enough period to make some kind of inference. In a rising market like 2003 to 2007, 2009, 10, 11, or 14 to 17, or the recent rise. In a rising market, mid caps rise more than large, small caps rise even higher. Similarly, in a falling market, mid caps fall more, small caps get trashed. And eventually, in panic, like in 2002 or 2008 or 2013, or as recent as March 2020, you will find all of them converging. They do not converge by blue, that is Sensex going up and red and gray falling. They converge on a decline. So what I'm trying to say is this discussion about small cap, mid cap, large cap is all the more around last 3-4 years because SEBI came with a regulatory change in 2018, forcing mutual funds to have each scheme a benchmark based on the capitalization and bring some kind of uniformity regulatory requirement on how much portfolio should be in that space. Unfortunately, people like us don't have that limitation. We are agnostic to the market caps because we are conscious of the fact that you cannot determine the capitalization dynamically at any point of time and fixed it for 3 years, 5 years. But what is important discussion is not whether we should look at large, mid, small. As I mentioned, large has too many stocks in too few sectors. You don't capture the length and breadth of Indian markets and economy. There are several components. To give an example, last year Indian paint industry may be about 45,000 crores. Indian footwear industry is double the size. Indian diagnostic services even larger than double the size. But 55% of the paint industry may be one company, and that may be large cap, and you will find that in every index. But the largest company in other sectors which are double the size may have 2, 3, 4% market share. They're all small and mid caps, and you won't find them in any index. So when you focus your attention to the large cap universe, that may be 80% of India's market cap, but they are all only 7, 8 sectors. There are several businesses out there which you can find only in small and mid caps. So the discussion is not on whether we should consider large, mid, small, but the discussion of index in these conversations. These slides may need some help to take you through what we want to communicate. The line graph, today we are in September 2022. I just took 3 years, but my team has these slides for 3 years, 5 years, 10 years. We have rolling basis, which means August 19 to August 22, or July 19 to July 22, or June 19 to June 22, or any 5-year period or 10-year period on rolling basis. But the story is same. What is the story? The story is the line graph is large caps, which had you invested 100 rupees in August 19, by March 20 would have become 70. To be the left-hand side, left is the index to be seen with the line graph. And by September 21, it would have become maybe about 160 and then declined to 140. Now maybe back to very close to 155. So how much large cap index has moved in the same 3 years period? About 50-55%. Each dot that you find, totally if you count, you will find 100 dots. Each dot is each large cap stock's actual 3-year return. I just spread these dots wide enough for optical clarity, but each dot is each large cap's 3-year bullet return to be seen with the right hand side y-axis. So what you will find there is when 100 became 155 in large cap, that's large cap index moved up 55% in the last 3 years. The impression people carry that markets have gone up a lot, they carry that impression from the recent March lows to September 21 high, when during this 1.5-year period, 70 had become 160. That may look like more than 125% return. How much markets have gone up last 3 years in large cap is about 50-55%. But during the same 3 years period, there are about 10 large cap which have given negative return, And there may be 10 large cap which would have gone more than 200 to 50% return. But majority of the large caps still did something like between 40 and 80. And 20 large caps make up more than 60-70% weightage in large cap index. And if you buy them, you are anyway covering majority of the large cap index. Is that the case in mid caps? No. 100 rupees invested in mid cap index by March 20 would have become little less than 70. And then it became almost about 180. It fell more and then it bounced back more. So how much mid caps index has done, say in the last 3 years? Maybe about 70-80%. But during this period, did all mid caps deliver 70-80? No. Maybe about 20-30 mid caps still are today lower than what they were 3 years back. And there are another 20-30 mid cap which have done not just 2x, maybe a little more than 3x also. And when you see that in small caps, absolutely there is no pattern. 100 rupees in small cap index in August 19, by March 20 would have become 60, fell more, then became 200, rose a lot. And during this 3 years period that the small cap index has moved 70-80%, did all small caps deliver 70-80? No. 1/3 of the stocks in that index are actually low today, trading lower than what they were 3 years back. And another 1/3 of the stocks would have given 200, 300, 350% return. So maybe in Sensex, okay, this is Sensex. In Sensex, 100 rupees in Sensex had become 70 and then became maybe about 150. So index would have become maybe about 50%. And most of the index stocks would have done between 40 and 80. Maybe one Sensex stock did 200% and one Sensex stock is down. So when you look at the 30 stock Sensex, it may look like they move in some kind of range. But that's not the case in mid caps. Certainly not the case in small caps. So in small and mid caps, index is of no use. If I'm building a portfolio of 20 names, which is what I would be thinking most of you would be doing, when you build a concentrated portfolio, what's important is whether you are buying these 20 names or these 20 names and not the index, which may be relevant in Sensex, may be relevant somewhat in Nifty, maybe in large caps, but not certainly in small mid caps. So when we discuss investment opportunities, let's discuss on the merit of the company rather than whether it belongs to share before we actually begin the main part of the presentation. Why people like us are super bullish. Before I give you sense of the domestic consumption, which is very large part of our economy, and that we believe over the next 3-4 years are going to be the prime movers of the economic growth in India, and that could throw enormous amount of investment opportunities. So even though as fund managers, we don't keep our scheme open 365 days a year, 24 hours a day, all the years. Instead, we choose to accept capital in certain limited time periods. And whenever we find opportunities, we knock investors. The rest of the time, we keep it quiet. And therefore, if you look back in the last 7 years, most occasions we raised money would have been when markets were in some kind of stress or decline. And many investors who know us for so long are themselves surprised that we are super excited in fundraising at times like this. And what is that we could see that is surprising to them is the consumption pattern change. While domestic consumption is the large part of our economy, and we are saying it will be largest part of our future growth in the next 3 to 5 years, what we mean by domestic consumption? Who is consuming what? So first thing is to understand who is that who that we are talking about. How is our demography placed? So we are about 140 crore Indians population. An average family size maybe about 4.5, 4.6. Sometimes average could be misleading. It's actually misleading in Nifty also. When people say Nifty P is 25, we are assuming that most of the companies in Nifty should be trading at 25. It is not. You will find maybe about 30-40% of the companies in Nifty, like Asian Paints, Nestle, Bajaj Finance, Titan, DMart, many other examples of companies who may be trading at 50, 60, 70, 100, 120 P. There are some infamous examples also. But the fact is that 40% of the companies trade at P multiples higher than 50 times. And then you will find the other end, maybe 20% of the companies like Tata Steel at 3P, Steel Authority, single digit P, State Bank, single digit P, several public sector names. So you can't put both of them in one index and say index P is 25. When you say index P is 25, 80% of the companies' P multiples are outside that range. So that's the misleading effect of averaging out. So our family size, even if you give that benefit of averaging out, which is about 4.6, it could be in a state like where I come from, Tamil Nadu, as low as about 3.2, 3.3. We are the lowest in India in terms of the family size. Delhi, could be about a little more than 5. Uttar Pradesh is 6.2, 6.5. And Punjab is closer to that. But Maharashtra may be about 4.7. That's the average is around 4.5, 4.6. So when we say 140 crore population, that's about 28 crore families of 4.5 people each. What do you find in the right hand side of the slide that we put is we are when we say we are a young country, we are of course a young country. Median age of India is about 28. 2/3 of India is aged below 34. But that doesn't mean our population has grown because more children are born. Okay, today at 140 crore population, we have less children than the number of children we had in India in 2001, first time when we crossed 100 crores. So our population last 20 years has grown 40 crores, not because more people are born, but because our life expectancy rate went up. All those big number of children in 2001 have become adults. They have not produced that many children. So the working age population as a percentage of total population, if you see in the left hand side, you will find various countries and you may find each of the countries where it peaked. Slowdown started thereafter. China, it peaked about 2012-13, and India we will reach there maybe about 2034, 2035. So the next 10-15 years we'll have a huge addition to the working age population as percentage of the total population and as well as in absolute number. But that sometimes could make some of our definitions a little indifferent. For example, when unemployment number comes, many people often, even reasonably sophisticated people, when they see unemployment number has moved from 4% 5 years back to about 8%, they think as if many people lost jobs. That's what it is. What else is how they ask. But when you ask what is the employment rate, many people think it's 100 minus unemployment rate. It's not. For example, if you take US, where people track unemployment rate almost about every month, whether they track it or not, some of our fund manager friends do it every month without knowing how relevant it is. But that unemployment rate, which if you take for US could be about 1.8, 1.9%. But the employment rate in US is only 71%, which means all adults aged between 20 and 60. Some countries take from 15 to 60, some countries take from 20 to 65, but that's broadly the range. When you take that range, 71% of adults in this group are employed, 1.9% are not employed but looking for employment. And who are the rest then? The balance 27 are adults who are neither employed nor looking for employment. They are not counted in the employment rate, they are not counted in the unemployment rate. Similarly, in India, the unemployment rate has gone up from 4% few years back to about 8.5% now, and people are fearing it could go to 9-10, and I think it will grow. That doesn't mean people have lost jobs. It only means number of people who came into the adult age and qualified and looking for employment has gone up. Employment also has gone up during this period. The actual employment numbers have gone up, but the actual pool adding into the employable age is a lot more than the number of people who got employed, which is actually a sign which we will discuss in subsequent slides. What kind of consumption demand is coming from that. That's on the demographic side. Then what drives consumption is the income side. Maybe after this is all public information, it's not very private. But what this slide gives you is a sense of what percentage of our population is what is called rich and wealthy, and what percentage of our population is what we call as affordable, rich, but upper middle class. What percentage of population is what we call as the lower mid. So many years back, you may know this lady, Ms. Rama Bijapurkar, who actually sits in several boards for last 5 years. She was director in Nestle, Axis Bank, Sun Pharma, several other names. And she also teaches as a professor in IIM Ahmedabad. One of the best brains, I would say, in India in mapping the consumer industry. And Tata's had helped her NGO in trying to do a consumer experience survey now for about 8 years, which throws a lot of information. And we took some of that to get clarity to these numbers. Even though we are seeing multiple tables of this, it doesn't bring enormous clarity as much as this table can bring. So if you put this 140 crore Indians on an average of 4.5 people in a household, and therefore 28.1 crore households in a scale of 1 to 100, where 1 is a farmer in Bihar, which is poorest, and 100 is, say, Mukesh Bhai or Gautam Adani, who is the richest Indian. And you put this 28.1 crore families in that scale of 1 to 100, what you will find is something which is not in the table. I can give you as a data point, therefore you understand this table a little more better, is if you go by wealth, okay, the household wealth in India, the 99 to 100, that 1% of Indian households own 34% of the wealth. The 90 to 100, that's 10% of Indian households own 62% of the wealth. And the 80 to 100, that's 20% of this 28 crore households own 86% of the household wealth in India. So highly concentrated, which is probably the reason why you have only 5.9 crore people filing taxes, only 5.4 crore people who have credit cards. You may have just about 6 crore people who have passports. Factually, these are all correct numbers, but the inference we try to make is wrong. It should not say that 5% of Indians pay taxes, or we should not say only 4% of Indians have credit cards, and you should not say only 4% of Indians have passports, which is factually right, but the inference we try to make could be misleading. How to infer that data is, for example, I'm the only taxpayer at my home, and my household is about 4 people. Doesn't mean 25% of Maran's household pay taxes. I'm the only tax earner or taxable income earner in my household, and therefore I'm the only taxpayer. So when you say 5.9 crore people file taxes, it actually means 20% of Indian families pay taxes. But still, it's only 20% of Indian families. That doesn't mean our tax collection is low. Last year, if you just take the central government's tax collection, it's about 11.5% of our GDP. And if you take most Western countries, the average could be somewhere between 18% to 21%. So we are about 70% as efficient as global average in terms of tax collection. But only 20% of Indian families pay taxes because 86% of wealth is that 20% of the families. 2 mistakes we should not commit in this is to link income with wealth as well as to link consumption with wealth. So just because 86% of money is with the top 20% of the people, it's not that 86% of consumption is the top 20% of the people. Let's look at the bottom 20. One thing you will find is the household size is inversely correlated to income size, which is something which we all may feel, but here is a data point to actually validate to that. The bottom 20% of India, that's poorest 21 to 20, they may have no share of wealth. They may have no share of savings, but they have almost 10% share of the total household expenditure, the consumption side. But what they consume could be rice, wheat, pulses, cereals, those kind of basic essentials, which partly is funded by grants and subsidies by the government, as well as some amount of private borrowing that you may find. The richest 20, they may have 86% of the wealth. They may have 70% share of the total savings households make. But their share of the consumption, their share of the household expenditure is only 36%. Even though it is only 36% share of the expenditure, it's not 36% share of every expenditure. For example, it's not 36% of the total rice, wheat, pulses, cereals. Their share is actually much less than that number. But their share of probably, for example, if I'm looking at wealth management industry, the consumption of wealth management industry products and services is mostly in the richest 20, maybe 90%, if not 100%. Okay. If you take bank deposits, almost about 92% of bank deposits are made by the richest 20 as part of their surplus income. So why I'm using this number is not to get this clarity on this number, but actually to make you understand what we show by these 5 different colored lines. The blue line is the richest 20, and they've been growing the most. And if you see in 2005, which is from where we could get this data from Tata sponsored NGO exercise on Indian consumer experience 360-degree survey that Professor Rama Vichapurkar did. And this is full credit to her. We've been liberally using it just to communicate that point, that on one side, when you say income inequality is rising, it's not entirely giving correct inference. But the fact is, the richest 20, even though they've been growing a lot and faster, and 2005, 8, 9, 10, 14, the rest of the 80% were growing, but it's at a much lower rate. But what you will find is in the last 4 years, the second 20, the yellow line, is breaking out from the rest of India. And what drives that breakout is very interesting. It's a combination of the employment nature, women participation workforce, and the role of graduates as head of the families, and the household's attitude towards. This breakout has been last 3-4 years, and because it just happened around COVID time, some people may attribute that to the COVID lockdown impact without, for example, just take our own industry. The number of demat accounts, right? Demat is a bare minimum you need to have to do any equities. And if you take that, 2010 was 2 crores, 2018, 3 crores, 2020, 4 crores, 2022, 10 crores. Okay. The number of demat accounts opened in the last 2 years is more than the total number of all demat accounts opened in the previous 20 years. This is not just on demat accounts. Take mutual funds. The total capital mutual funds have raised in the last 4 years is more than the total capital they raised in the previous 20 years. You take PMS industry. The total capital PMS managers have got as fresh capital from investors in the last 3 years is more than the previous 20 years. And that's not coming from banks, because SP account balance is all-time high, current account balance is all-time high, term deposits all-time high. This change is not just on the savings side, which we can say financialization of savings, but this change you could see in the consumption side, many line items. For example, under domestic consumption, we put all kinds of items like toothpaste and footwear. Both are domestic consumption. But in the last 10 years, toothpaste industry has grown 1.5% per annum. But footwear industry has grown 10 times of that number. So what distinguishes 10x difference between 2 line items in consumption is the household income growth going in the second category. If you are a household of 4 people and you earn 25,000 rupees salary, which is 8,000 rupees per capita per person in that family, when that moves to 50,000, number of times you brush doesn't change, but number of footwear at home doesn't double, it actually triples or quadruples. So we could see volume growth in various businesses. We just put them under the 4 categories, but these are all specific products where you may find exceptional growth in volumes as compared to the previous years. But that volume growth is not because people are buying more. is because more people buying out. Even though it's a subtle difference, there is a strong message behind these two, because what drives these two are very entirely different. The number of accounts open, demat accounts open in the last 2 years is more than the previous 20 years. Is it because people like you and me who have been having demat accounts last 20 years open more in the last 2 years? Or people who never had demat accounts in the previous 20 years have opened in the last 2 years? We think it's later. If the number of air conditioners sold in the last 4 years is more than the previous 10 years, is it because people bought more air conditioners in the last 4 years? Or more people who never bought air conditioners in the previous 10 years have bought in the last 4 years? It is more who are they, is what I explained. What they buy is something which is a very provisional list. List may change, and we have been doing so. What therefore it is clearly showing is some of these consumption items is growing partly because household income is growing. Household income is growing not because salaries are growing, but because women participation in many families have helped the family household income to grow. And that women participation, to give a number, if you take the employment number, India is about 45%, but it is 64% male and 16% female. But if you take graduates, we produce almost 59 lakh graduates a year. Out of them, little more than 52% are women. So while women constitute 16% employment rate, where male has 64% employment rate, more than half of the graduates are female. So you will find the women employment rate rising, and that is a lot more in 60 to 80 than to 80 to 100. Secondly, their attitude to credit has also changed, which we have done interesting studies in some of the videos that we have explained in greater detail that you may help. So this gives us enough perspective on why people like us are super excited in going and buying what we call as consumer discretionary businesses. But as you know, discretionary is not a homogeneous business. We should be conscious whenever we discuss sectoral investing, whether the sector is homogeneous in nature or heterogeneous in nature. There are several businesses in India which are homogeneous in nature, mostly commodities, even for that matter, IT or banks, where what is homogeneous? Some big macros may have somewhat similar impact across the industry, and therefore some may do it better, some may do it less better, but otherwise the trend will be somewhat similar. But a heterogeneous nature, the same, for example, civil aviation, if you take, is extremely heterogeneous in nature. In the last 5 years, someone would have done 3x and someone would have gone bankrupt. Broking is heterogeneous in nature. Last 5 years, someone would have grown 10x, and the rest of the industry, 90% of the industry would have shrunk. Gold jewelry retailing is heterogeneous. Wealth management in a way is heterogeneous. So there are certain types of businesses that we evaluate more based on the fundamentals. So therefore, taking a holistic view on the sector could be counterproductive. It's a caveat forewarning before you use any of what I said. But to use what I said is when we understand that domestic consumption is strong and that's driving 60% of economy, and that's unlikely to change in the next 3, 4, 5 years. And therefore, is this a time to be optimistic? The clear-cut answer is yes. That's my brief. We'll be happy to take questions. Thank you.
Right, Mr. Maran. I think this has been one of the very unique webinars, where we have not spoken anything about any of the products of UNIFI, but it has been absolutely very, very educative. The way actually we always intended to do when we had started the process and discipline of doing these webinars, but somehow fund managers, when they come, they are unable to actually keep their love and affection to their product. We always remind them we'll only do an educative conversation, but I am really kind of I would say it's one of the very unique things that you have done today by not talking anything about your product. And coming to the questions, the very first question, which I think while I was looking at chat, which investors want to ask, that today, when we say that India's economy is resilient and the domestic consumption story is something which is ongoing. Maybe many of us did not understand it in time, and we have lost various opportunities. But on ongoing basis, there are going to be many opportunities ahead of us. But at the same time, the behaviors have been changing with new age businesses coming up, and these new age businesses over a period of last maybe couple of years saw very very high valuations, and then they have come down. So while the demographics of India's economy are attractive, the age is young, right? And these new age businesses, which to say were startups maybe 5, 5, 7, 10 years ago, and now have got listed, and maybe there are many more IPOs which are lined up. How do you see this space, and how do you fit it in terms of the changing consumption pattern, in terms of your overall, I would say, study that you have been doing over last 2 decades?
The average age of companies we hold in our portfolio is 29 years. So maybe we are a different breed we look at, because there's two advantages when you invest in such businesses. When you invest in companies which have 10, 20, 30-year history, the promoters would have left enough trail over these years for you to understand. And that gives you a better perspective. I think in one of our Upanishad, some story I remember I have read, competence you can judge only from a distance. Character you can judge only at close quarters. And if both you can't judge with the new age businesses, what are you buying? You're buying a piece of paper which is moving up and down in value. Would I look to be a partner to them in this business venture is the question you should ask before you buy a stock. And we choose not to. See, in all markets, we should not let a business opportunity influence our decision to invest. When I began my career in 91, I remember some of very strong minds used to say, those days in Sensex, more than half of the Sensex used to be steel, cement, power, textile stocks. There's not even a single IT company, not even a single pharma company. Actually, only one financial services. Those days we used to have Industrial Credit and Investment Corporation. That's the only name with hardly 2-3% weightage. And textile stocks used to be flavor of the season because people used to say, India has only 80-90 crore population. Soon it is going to cross 100 crores and prosperity levels are going to go up and people are going to wear suit boot and people will have 3 shirts instead of 1 shirt for every occasion to have, and therefore per capita consumption of textiles will go through the roof, and therefore textile company. But there is one index I have by manually preparing the top 10 textile companies of 94. They finally came back to 94 price in 2011. That's textile industry for us. Industry grew, but what happened to the companies in the industry? So I think it is Saudi oil minister who said, Stone Age did not end for lack of stones. Oil age did not end, is not going to end for lack of oil. Similarly, we should not buy insurance stocks because we think insurance industry is going to grow. Insurance industry for sure will grow 10x from here, not necessarily insurance stocks. Mutual fund AUM can triple in 5 years, but HDFC AMC can be all-time low. We need to understand what is driving the industry, and what drives the industry earnings is not the industry size. It's how much of that size is captured by the company and at what margin you capture the market share. These two determine earnings and that determines valuation, not the size of the industry. So in new age businesses, we lack both. We are not able to quantify the size growth. We are not able to quantify how these guys are going to get margin. Here, how do we evaluate a minus 30% margin improving to minus 5% margin when there is no earnings? So it's completely out of what we call as our circle of competence. We, of course, try to learn and enhance our circle of competence, but we never invest outside circle of competence. So 90% of new age businesses are outside our circle of competence. There are 1 or 2 businesses in this which should business. And if we have already done strong homework on that, For example, if there is a women bottom wear company, it may sound like a new age business, but it's a business which has been around for a while, and some names of that could come into our universe. For example, but it's somewhat an existing business model where you are able to relate over a 10-year, 15-year cycle. And some of those names could come. So it's not that we have any agenda against the new age businesses, but we don't have the competence to evaluate their size of growth and their margins. Yeah.
Sure. What's your view in the current context, with regards to the digital businesses, IT businesses? Till 6 months ago, everybody was gung-ho about IT, that order books are at all-time high, and post-COVID world has brought two structural shifts. One is manufacturing and second is IT. Though manufacturing still continues to perform, and obviously, the views are positive. However, IT is going through a very tough phase, and I have seen various fund managers have reduced their weightages to IT. So, how is UNIFI Capital looking at IT at current valuations?
We don't take sectoral view here. We don't have a view as such on it. But I think um, most businesses that are super sensitive to global environment, you need to be quite dynamic. And if you know that you can't be dynamic, it's better to stay out than to get out. Right? So it's not that we should be present in all best performing sectors. There are certain time periods, certain sectors will enter where things could change very dynamically. And if we know that we are in the last in the information queue, we should not be in those sectors. So many of the names you mentioned come somewhere there. But the domestic oriented ones, I don't see a reason for them to change their dynamics between this week to next week. So I think it is better to uh, stay out of most businesses which are super sensitive to the global developments, country level developments, because it's not that I have clarity you don't have. People is fact is most people don't have, and it's not that we have to have clarity to do well in markets. We need to have clarity on the businesses we want. It's not that we need to have clarity on every other good business. Yeah.
Sure. Though recent past, especially last 1 year, has more or less taken away this concern and threat that domestic equity markets are dependent on FI flows. But still, because 25% of equity markets are owned by FIs, and because most of the FIs belong to the western part of the world, and since western part of the world is increasing interest rates and is kind of struggling in terms of growth over next 3 years, what is the kind of role that FI flows will play in terms of the ongoing expectations that investors have from equity asset class in Indian context?
FIs do not own 25%. They own 19%. Out of 3.5 trillion, maybe about 650, 660 billion is what FIs own. Numbers could be slightly different here and there, but it's not going to make more than half a decimal point. So this 19% FIs own, for example, take Reliance, close to 250 billion market cap, 26% FIs own. That's about 65 billion. 10% of FI, one company. Take HDFC Bank. 71% of HDFC, 64% of HDFC Bank FIs own. That's about 100 plus billion. So out of 19% FIs own, 34% is in three stocks. And stock number 4 to 50 is another 51%. And I don't hold many of them, or I don't hold any of them. So I don't worry about much FIs. Having said that, we are trying to give disproportionate importance to FIs on wider market. For example, when last 3 months FI selling was gaining a lot daily, and 6 months, they have sold 30 billion. Last 3 years, they have sold 38 billion. I used to joke among my friends, the cumulative FIA selling last 3 years is less than the amount of gold Indians buy in one marriage season. Okay. So FIAs are important, but they're not that important as we give so much disproportionate importance. They're very important in those 50 stocks. But outside the 50 stocks, they're very margin players. There are at least about, out of 60 plus billionaires India has produced. Forbes publishes that list, right? The last list had 142 names, billionaires list. And 5 years back, we had 80 plus billionaires. So India has produced 60 billionaires in the last 5 years. And if you ask people which industry has created highest number of billionaires, many people will say it's IT, technology, startup, or FIA-backed business. Okay, that's actually chemicals. Right? Chemicals have produced more billionaires than any other industry. And none of these chemicals business were FIA funded. So what I'm trying to say is FIAs will eventually come and invest not because we need FIAs, but because they need a large liquid market where there is growth. So we don't need to worry about FIA activity. We need to focus on whether the growth that we are betting on truly happens. If that growth happens, FIAs do come. And if FIAs do not come, that's still okay because domestic liquidity. The domestic liquidity people have forgotten. Because we spend so much time looking elsewhere in the world, we forgot to look at what's happening in our own backyard. Right? Where is this domestic liquidity coming from? It's not coming from Bombay and Delhi. Right? That's why we lost sight of it. For example, 10 years back when mutual fund AUM was 9 lakh crores, which reached 40 lakh crores last March. When it was 9 lakh crores, 46% of the money came from investors in Mumbai. 16% came from investors in Delhi, that include Noida and Gurgaon. So 62% of mutual fund industry used to be city number 1 and 2. And then 3, Bangalore, 4, Delhi, Calcutta, 5, Chennai. Those 3 cities were about 12%. City number 5, city number 6, Ahmedabad, 7, Pune, up to city number 30. That's 25 cities were about 18%. City number 31 to rest of India was hardly 8%. The city number 31 to rest of India, which was 8% of 9 lakh crores, is today 23% of 40 lakh crores. That's where it is coming from. And that's why HDFC was the largest mutual fund 5 years back. And SBI was nowhere in the top 3. Today, SBI is the largest mutual fund. And HDFC is not at all on the list. It's nothing to do with performance. If we have 17,000 PIN codes, the SBI could collect investors' money from 92% of PIN codes. The power of domestic liquidity we have underestimated a lot. With all this buying, equities have gone up from 2.5% to 4.5% of household wealth. So we have a long way to go. And today, the average age of savers have declined, and the average household nature of income has changed. The average age of billionaires has fallen. Average age of the savings pattern of the affluent, what we call as 100 crores plus families, is no more real estate in quote. So you will see the domestic liquidity more than compensating for the uncertainty of FIAs. But the FIAs do come not because you and me need them. They do come if they see the growth happening. And domestic consumption is something when that becomes reality. I think our transition from 3.5 trillion to 5 trillion will be much faster than the most optimistic estimate that we currently have. And that when it becomes a reality, you don't need to send invitation to them. They'll come on their own.
Right, Mr. Maran. The subsequent question and the last question, for this evening to you, as we will progress as an economy from 3.5 trillion US dollars to 5 trillion US dollars, how do you project, the weightages of various sectors in maybe NSE 500? So today we have financial services followed by IT, followed by consumer discretion, right? So will this order remain same? And if change, in what context? Or if remain same, which sector will kind of add more?
It's a good question, very, very thoughtful. And last year we made maybe about 200 plus crores in fee income, and we take some 14, 15 decisions, correct? So each of those decisions our clients pay 10, 15 crores. And you were asking what is that decision is uh, for free. So instead of saying those individual decisions, I will put it this way. When I began my career in 91, 54% of Sensex were steel, cement, power, textile. Okay. When we reached $1 trillion economy in 2002-3, the same steel, cement, power, textiles declined from 54% to below 20%. Economy grew, markets tripled, but these four sectors from 54% of the economy became below 20%. People don't realize in 2002, the IT, pharma, real estate were more than half of the industry, half of the index. Financial services are still 10% only. From there, it has come here. One thing I can be reasonably confident, when we reach 5 trillion, financial services won't be 40% of Sensex, like what it is today. It's not going to be 40% or 50. No way. Okay. The industry could get, industry will become larger, much larger. But it's not going to be with five guys. And it's not going to be banks alone. We will find different guys. IT may not be dominant part. You will find several names in the consumption side. Consumption side, so far we have seen mostly staples. Mostly soap, detergent, shampoo, toothpaste, um, milk products kind of companies. You'll find several names outside the 200, 250, some of them coming in the first 100. Who knows? Few of them could come into the first 50. And you will find a material change in the composition. We have reasonable clear idea of what sectors are going to lose some of their weightage, but we don't have great clarity on which exact sectors are going to come. But there are enough indications that the domestic consumption driven businesses, for example, when we did this work on and S&P 500, how many companies belong to what sectors which doesn't have even a single name in BSc 500? There are quite a few names in that. For example, bed and bath is a big industry in the US. And except one or two companies that do small caps in India, we don't have any dominant businesses. And then you realize only 6% of Indian households have mattresses, only 8% of Indian households use or many of these products. And then you will find the growth rates. But how many of them will trigger in the first layer of growth? How many will participate second layer? And how it is going to take shape in industry consolidation. These are all things which will determine weightages, right? For example, as I mentioned to you, toothpaste would have grown only 1.5%. Footwear industry would have grown 10 times of that number. But if the largest player in toothpaste, which has 55% market share, is a large cap, but the largest footwear company with the 4% market share will still be a small mid cap, and his weightage will be less. So the weightages in index is not going to be a reflection of time to time industry growth, but it's a reflection of type of growth also. If the growth is going to be driven by just four players in the industry gaining all the market share, some of them could be large cap. You take wealth management industry. Wealth management industry, which advises PMS, AIF, mutual funds, they all have grown a lot. You look at your own percentage, you would have grown 20, 30, 40, 50%, right? So mutual fund industry has grown from 9 lakh crores to 40 lakh crores in 10 years. PMS industry has grown from 23,000 crores to 2,60,000 crores. And then 10 years back, AIF industry didn't even exist. It's already 50, 60, 70,000 crore industry. And if wealth management industry is servicing that industry, who's the largest wealth manager? Some people say IIFL, some people say Kotak. But if you ask what is their market share, and the largest wealth manager is a small cap stock. Right? Now, if you build the story bottom up, then you will know which are all the businesses where the next nifty companies and what kind of weightages they will come in. Because it's a function of business growth as well as the type of that growth. If it is going to be If wealth management is going to grow like broking industry, when I started my broking career in 91, we had 1,300 brokers in BSc. And we had several brokers in regional markets. But when NSE came with satellite technology, VSAT terminal, transparency, all the regional exchanges got. Even 10 years today, little more than 55% of the daily volume in NSE, BSc is just 10 broking firms. So if that is the kind of growth broking industry is going to have, each broking firm could be a large part of the index. But if the industry is going to grow in more fragmented manner, then you may not have Nifty weightages. But you may still have, we don't need to have Nifty weightage. For example, there's no chemical stocks, there's no specialty chemicals in Nifty, but that industry has created enormous wealth for shareholders. So we don't need to necessarily measure investor wealth creation future based on Nifty weightages. But I think if there is a fair chance, you may see the weightages dramatically changing between 3.5 trillion to 5 trillion. And we have some obvious names where the weightages are going to come down dramatically. And we have fair idea of maybe 3, 4, 5 names where to look for big positive changes. But that knowing that alone may not help us in stock picking. But having that may help you to increase your allocation to some of these names and weighting them even though they become slightly overpriced for a while. That's how we look at it.
Sure, Maran. Thank you so much. I will just conclude this session by thanking everyone and saying that, to build your wealth at 10x kind of return over 10 years, so basically growing your wealth at a rate more than 25, 26% requires high performance investing approach. And that requires deep learning, continuous effort to upgrade yourself. And that is where we have created this platform, PMSAF World, with the business punchline as high performance investing. And we only associate with best funds and best products. And obviously we deep dive and understand quality, risk, and consistency attributes. And the discipline that we kind of follow is based on our passion for the work that we have taken in our hands. And we thank you, all of you, to having given us so much, in terms of the audience and clients that we have kind of added over last 3 years. And we are continuing this effort with the good wishes of all of you. Thank you, Maran, once again for sharing your insights today. It was really very insightful, and I have personally gained, I would say, great details to the learnings that you are sharing. I wish I had more time. We have already spent 1 hour and 20 minutes. Otherwise, there were a lot of other questions which were on my mind. Thank you so much. We'll bring Maran once again, for a discussion here onwards. I think it is leaving the episode somewhere in middle. But yes, thank you again, everyone, for logging in today.
Thanks for the opportunity. Appreciate having me this evening. Thank you very much. Look
My
forward.
pleasure.